Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we discuss the state of the Sydney property market. Louis, thanks for joining us.
Good to be with you once again, Peter.
Louis, coming into 2024, there was a range of forecasts from experts such as yourself as to what would happen with Sydney property. And I must say, unlike previous years, the spread as to what experts thought were going to happen this year was wider than it's ever been. So let's go straight to the numbers. What has happened year to date in the Sydney property market?
For the Sydney housing market, housing prices are up so far in 2024. We've got it up by about 2.5%.
Okay, so it's just running a slightly above the rate of inflation, given inflation's around mid-threes.
Yeah.
And you're saying annualised there, we're running at about 5%.
That's right.
Why were the experts so conflicted this year as to what would happen with Sydney property prices?
Well, Peter, I would argue each year they're always conflicted, but yeah, I hear you. Yeah, there was some outliers out there. Look, it's difficult to forecast housing prices per se. Very difficult to begin with. There's so many X factors out there that can play out through the course of the year through interest rate changes, taxation changes, migration changes, supply changes, of course, and all that can influence the housing market. Our forecasts were that we would see essentially a flat to falling market depending on where you were around Australia. We were very bullish on the Perth and Brisbane and Adelaide housing markets, and on going back to Sydney, our forecast was that housing prices could fall a little. The forecast was that we believe prices might change somewhere between -3% to +1%.
So we might bring up this slide here, which is our base case scenario, which you had Sydney -4 to flat.
-4 to 0% is our forecast, that's right.
Yeah, indeed. So we're at the halfway mark of the year. As you say, it's up 2.5% for the year, annualised, suggesting 5% growth. How are you feeling about your base forecast?
Market's looking as though it's moving a little bit better than what we expected. We're at the half-year point. There is still the possibility that we could see housing price falls in Sydney for the second half of the year. So we're not ruling out our base case at this point in time for Sydney, but I've got to say, yes, the market has done a little bit better than what we expected.
We'll talk more about immigration numbers shortly, but if we do go to scenario 3, late last year, that was actually my preferred scenario of the ones you put forward, because I felt that the government would tell the public what they wanted to hear on immigration, then continue to stay the line, which would inevitably push Sydney property prices up and Sydney rents due to the lack of dwelling supply. Of those scenarios, where do you think scenario 3 rests in terms of probability coming up on the right side up?
The probabilities have increased somewhat. So when we look at the more recent data from the Australian Bureau of Statistics, they release net overseas arrivals. And for the data through to April, which is what they have, that data was actually a little bit more positive than what we expected. But we're still not ruling out a fall in the growth rate of net migration for the second half of the year. And unfortunately, given the lagginess of the data from the ABS, we won't actually know the true net migration numbers until we get to about November for the first half of the year. So at this point in time, that's the big unknown. What the actual population growth rate will be for this year. Now, if we do get a population growth rate of greater than 500,000, it definitely puts our third case scenario in play. And when I look at those numbers, yes, they're more in line with what is happening right now, which is interesting. That said, some of these cities are moving a lot stronger than what we anticipate. For example, Perth. Perth's already up by about 10%. For the 6 months.
Coming off a very low, essentially depressed base, Perth, isn't it?
That's right.
As Brisbane was 2-3 years ago.
But with the rapid rise, and it has been a rapid rise across 23 and 24 for Perth.
Louis, we're talking numerically about the population growth. I want to go to a more nuanced point though, and that's the profile of the people that are coming into the country. because unlike recent times, it seems to have changed, and the change in profile seems to be benefiting or fueling the housing market further, if I can say that. If I go to a point that we heard in the commentary late last year, that more millionaires moved to Australia than any other country last year. And when you look at the global geopolitical space, Australia and New Zealand were considered safe havens away from a lot of the troubles that seem to be happening elsewhere.
Yes.
And if I can bring up our next slide here, we see headlines like this: foreigners buy $5 billion worth of Aussie homes, where in the past, people coming into the country, we associated them more so with students and backpackers and people here on a working holiday. But have we seen a change in the profile where we're seeing more cashed up professional people coming in on what's a relatively weak currency and taking advantage of that in the housing market?
Right now, there's no hard data for 2024 that we can point to say that's exactly happening. But I wouldn't be surprised that it's happening. Yes, let's recall too that wealthy foreigners can actually buy their way into the country with special visas if they have a certain net worth amount, and many of them do. So
is that partly why we're seeing such a strong upper end of the housing markets, because it is that wealthy overseas investor that's coming in and buying their way in?
Yes, I think in part it is that. But once again, I'm an analyst, Peter, and we can only speculate because there's no hard data at this point in time.
So when you see a headline like that, do you go, well, this is a beat up, or do you say, that's interesting, I want to see further analysis on that?
I want to see further data.
Yeah.
That's speculation.
Yep.
They're not really basing it on more recent data.
Right.
Okay, so that we have data from the Foreign Investment Review Board that only updates annually. Okay, and the last count they had, that was only through to 30 June 2023. So a lot's transpired since then, of course.
Of every 10 immigrants that come in, net 10 immigrants that come into the country, how many land in Sydney? Any sense of that?
Yeah, Sydney is their number one go-to city, closely followed by Melbourne. So it's Sydney and Melbourne that has the lion's share of net overseas migration. And then what you see after that is Brisbane. And then it filters out through to the other states through interstate migration flows.
Yeah, so is there anything the government can do there to incentivise people to head to parts of the country that probably would welcome population growth and therefore economic activity around that?
They could certainly bring in taxation incentives to do that. They could try and force the hand of foreigners to say, all right, well, you're going to be allocated to this area, but there'll be nothing to stop those people moving to where they really want to go to. So to me, I think the answer would be yes, taxation incentives to live in certain areas might be to play to address this.
Louis, changing tack now, we caught up with you in late 23.
Yeah.
And at that time, there was a sense that interest rates were on hold for the time being.
Yes.
And then we came out of Christmas, and whether the RBA were responsible for this messaging or analysts in the media misinterpreted it, certainly Jerome Powell in America flat out said to the public that rate cuts are coming, and people jumped to the conclusion that rate cuts were coming here in Australia. So whilst the property market has risen 2.5% in Sydney for the first half of the year, as a real estate agent, I felt most of that growth packed on in February and March, as buyers, probably unwisely in hindsight, were factoring in the rate cuts they were told they were getting, which now seem unlikely.
I strongly agree with you. I noticed too that at the beginning of the year there was a lot of media speculation and expectation, outright expectation, that an imminent rate cut was coming. And I think market participants at the time, both buyers and sellers, were essentially pricing in an imminent rate cut. It didn't materialise. And I'm not overly surprised, because I think in more recent times, the RBA has been more guarded in terms of where they think interest rates are going to go, following their famous no rate rises until 2024 statement they made some time ago. So they've been on the record as saying, look, it's a very uncertain environment. Interest rates could go either way. And I think they've been fairly consistent with that messaging in 2024.
So you're comfortable with the RBA's messaging, which is fair enough, but how did the media get to the position here in our slide where they were universally setting the public up for rate cuts that are clearly not coming?
It's a very good question to ask many of these pundits who came out with the expectation that a rate cut would be coming. Clearly the media's got it wrong. And I don't think they can really point to something that the RBA specifically said, other than the more recent statements on monetary policy. The RBA has probably been a little bit less aggressive about a rate rise, and they're being more open to, hey, rates could go either way. And they've also recognised that the economy's been slowing, but they've also stated very clearly that there's still been inflationary pressures out there, and hence the reason why they're more guarded in terms of which way they need to go.
There was an inflation number out in America overnight. Did you see that?
Yes, I did.
Yeah, okay. What do you take out of that number for both the US market and then what that'll mean globally?
Overall, it was a good CPI number. So US inflation is now under 3%.
Yes.
Remember, at one point in time, it was getting towards 10%. So the central bank, the Federal Reserve's done a lot of hard work to bring the inflation rate down in the US. They are clearly getting closer to a rate cut, and I also note in recent days we had the European Central Bank cut rates and we had the Bank of Canada cut rates as well. So around the world, central bankers are starting to move interest rates down. When the Federal Reserve moves, that'll be critical to what the RBA does, in my view. Now, the Federal Reserve has just stated that, okay, they need more information and not about to cut rates anytime soon. So there still be may well be some months for the Federal Reserve where they just stay on hold. But clearly the outlook is more positive for interest rate cuts with the Federal Reserve. And therefore, when we look back to our market, the probabilities of a rate cut sometime maybe towards the end of this year have risen.
Okay, so you're not seeing the first rate cut in 2025. You still think we'll get it late in 2024?
I think there's still a possibility of a rate cut in 2024. Yep. What will be key is what unemployment does over the next few months.
Well, let's go to that point.
Yeah.
Inflation stays sticky,
yep.
if not creeps up, but unemployment starts rising.
Yeah.
Which poison do the RBA pick?
Yeah, they're in a rock and a hard place. They're dealing essentially with a stagflationary environment. Not overly stagflationary like what we had in the 1970s, but still elevated inflation with higher unemployment. A very difficult position for the RBA to be in. My hunch is that they will first focus on inflation. And unless the economy goes into a deep recession, I don't think that will happen. But their focus is on inflation. They were expecting unemployment to rise. It has been rising. If it rises aggressively, like towards, say, 5.5%, 6%, that might force their hand to a rate cut sooner than expected.
See, when the European Central Bank cut their interest rate last week, the true numbers were not there to justify a cut, but they felt the trend line justified a cut.
Yes, they were trying to get ahead of the curve.
Get ahead of the curve, that's right.
They're taking a risk though, because
Correct.
If they stimulate the economy too much, where inflation is still elevated,
they get a second coming of it.
They risk a second wave of inflation, that's right.
Yeah, can you see the RBA taking that sort of a position, or will they wait for the data to emphatically have turned the way they want it to?
I think they'll wait for the data. I think they are concerned about a risk of a second wave of inflation. I got to say though, on the data in terms of oil prices, the raw commodity prices, that would suggest that the probabilities of a second wave of cost push inflation, that's what it is fundamentally when you look at commodity prices pushing up overall prices, that's come back a bit. So I think the probabilities of a second wave of inflation have lowered a little, but we cannot rule it out at this point in time. And yes, there is still a risk that if you stimulate demand, you're pushing the economy up against its capacity constraints real quickly.
And that's the political debate at the moment, isn't it? The Liberals are saying to the Labor Party, you're creating domestic inflation. If you're managing the economy better, inflation would be lower. Labor are saying, understandably, it's global inflation. We're just at the end of the line.
Look, I think they're both right to an extent. It's what we call in economic terms, cost push and demand pull inflation. And we've seen a bit of both with this cyclical increase in prices over the last few years.
Louis, I want to go to household budgets specifically. Coming out of COVID, we were told that households were sitting on record savings.
Yes.
And have we got any sense of whether households collectively are running cash flow negative, living off savings, or at these current interest rate settings, are households running cash flow positive?
So the data on savings rates is that we've seen a material fall in savings rates. So at one point in time, if I recall, during COVID, we had saving rates greater than 10%. And I think the latest numbers suggest that's fallen to about 2 to 3%. We've definitely been eating into our savings to get by with these rises in interest rates.
So that's got a limited lifespan, if you like. Have we got any sense of when that sort of hard crunch for households could hit?
Yeah, a really good question. It could happen any time, no doubt about that. Interest rates where they are at the moment are definitely contracting the economy, and we can tell that through the rise in unemployment, the fall in retail spending. So to your point, I think it's kind of happening, but not in a real recessionary crush way. Keeping in mind, of course, we've been having for a number of quarters now a per capita recession. So our living standards have been falling in this country for the last 12 months now.
If you follow the messaging from central banks across the world, this is the sense that I get, but I'm happy for your input on this. I'll be keen for your input on this. You get the sense that central banks know there's a crunch point not too far away, which is why they're messaging to the public, we feel your pain, we see your pain, and we will react with rate cuts when the time is right. It's almost like their intelligence is telling them there is an inflection point where the economies can't take much more of this rate pressure. Is that a fair comment or not?
I think that is a fair comment, but they can only act with the data they have.
Yes.
So one key piece of data is we've discussed is the unemployment rate. I think that would, what you discussed, would manifest itself into dramatically higher unemployment. Now, we haven't seen that across the world yet. There's been a tick up in unemployment, but not aggressively so. Now, if we were to see a deep move into higher unemployment, as mentioned before, I think that would force the RBA's hand and would force the Federal Reserve's hand. And as we've seen with the ECB and the Bank of Canada, some of these central banks are trying to preempt that, to try to be ahead of the curve.
And if they pull it off, they're heroes, and if they don't, they're chumps.
Then they've got a second wave of inflation on their hands, which will put them in a far worse position than what they are now.
High stakes poker.
Indeed.
Louis, this is the net overseas migration numbers, actuals and projections from the federal budget. I just want to talk about the rental market and to the sales market to some degree.
Yeah.
The government, as we all know, have flooded the place with overseas migration, but they are promising in their projections 2024, 25, 26 to effectively halve the number of people they let into the country from its peak. Based on the fact that demand is fully stocking the housing market at the moment, what happens to the rental market if 260,000 people a year continue to come in and we're not building enough dwellings?
Well, we're certainly not building enough dwellings right now for 260,000 people. It seems as though for this year we'll complete somewhere around 130 to 150,000 dwellings, and I've actually reduced our estimates. We were thinking it would be about 150 plus, but no more than 160. But looking at the building approval numbers and the cancellation rates, the real number for this year is looking now about 130, as mentioned before.
So 130, it's 2.5 per persons a household?
About 2.6, yeah.
Yeah, okay. So that number will get just above their projected
That's migration, but then you need to take into account the natural increase of population, births over deaths, and that's about another 100,000 people.
Right, so they're clearly in the red on housing supply.
They are, and they're well and truly behind their goal of 1.2 million dwellings by, I think it was 2028.
Yeah, and we clearly don't have the tradespeople to build those.
No, well, we need to do more training. There's no question about that. I get concerned though when that the argument is, okay, we need to bring in more people to help build homes.
They make the housing crisis worse.
That's right, because the moment someone comes in, they need a home right away, don't they?
Yes.
So we need to try and train internally for these tradies. There's no question about that. And I think before this cycle is out, we are going to see more building collapses. I'm still well aware of many builders,
contractors.
Yeah, yes. Builders and contractors losing money as we speak on every build they do.
Yeah, it's a tragic industry at the moment, isn't it?
It is indeed, and
tough space.
I mean, we will eventually get out of it. We're in a cycle, but the government's got to do some smart things. It's got to have tax reform on the building industry. Taxation in terms of building a new home is one of the biggest single costs you'll have when you build a home right now. So we can see opportunities to cut taxation there. At the same time, I think there needs to be a bit of stick there for builders and developers as well. We don't want to see land banking at this point in time.
Louis, on social media, I noticed that you picked up some weakness in the rental market, which is a real surprise. We are in winter, which is never a great time for the Sydney rental market. Tell us about that.
We did, yeah. So for the 30 days to mid-June 2024, we recorded a 0.5% decline in rents for the capital cities. Now, in the scheme of things, that isn't much at all. But what is interesting is that was the first material decline we've recorded since April 2020. That is significant. It is significant, and it does suggest that seasonality is starting to influence the numbers. And I couldn't have said that for 2021 and 2022. The rental market was rising like crazy, that there was just no seasonality feeding through. In 2023, we saw a little bit of a lull with rents during this time. This year, we're seeing a little bit more of a lull, and that's interesting. It's potentially suggesting that we're getting through the worst of the rental crisis, but I must say we're not at the end of the rental crisis by any means.
It'll kick again in the warmer months.
But it is interesting, and going deeper into the numbers, where we saw the greater rental falls were actually in the upper market for Sydney houses, top end of the rental market in Sydney. So we recorded, if I recall the numbers, about a 2.5% decline for properties towards the top end, Sydney's east and Sydney's in the west, and Sydney's lower North Shore, as well as Sydney's northern beaches, recorded the bigger falls in rents during the last 30 days.
And do you think that's a function of the immigration numbers coming down, as the government told us they were year on year in the budget, or is it more a function of tenants are maxing out on price and in this cost of living crisis are hunting cheaper dwellings?
I think it's still more the latter, though I do believe that the reduced number of students out there is also impacting upon the inner city market as well. We recorded a rise in CBD vacancy rates. But going to the point of why would more affluent properties be recording falls in rents? Potentially it could be because the local economy in Sydney is starting to slow. We often see this when we see a slower Sydney economy, that the top end of the rental market starts to come off.
Yeah, but we're not seeing that in the top end of the sales market, are we?
Not as yet, though. Yeah. You wouldn't say that the top end of the sales market's skyrocketing.
Yeah.
It all depends.
Not like it was last year.
Not like it was last year. So I like to follow closely the property price range of about 2 million through to about the 5 million mark.
Yes.
And I'm noticing a bit of a slowdown in that range for Sydney. I would have to say indeed that for that range, that the market's flatlined.
Yeah. Now you've picked up we'll close on this point. You've picked up a 2.4% increase in property prices for the first half of the year. What has been the best performers amongst that, Louis?
So that would be the middle end of the market, the unit market in particular.
Okay.
Keeping in mind 2.4% is not exactly shooting the lights out. It's almost flatlining. So we've seen a lot of patchiness in the Sydney housing market at all parts of the market. I couldn't really point to any part of the Sydney market which I could say is booming right now.
Yeah.
I hear you. I think you've seen the very top end, seen some very interesting sales transactions, which would suggest that the most affluent properties are still doing well. And you might be right. It's very difficult to actually get good data on that very top end of the market because it's so micro. But from what I can see is, as mentioned, that 2 to 5 million mark, I'm not seeing a lot of fireworks there.
So it's evenly balanced between buyers and sellers, and we must note that it is evenly balanced on fairly reasonably tight stock levels. You've picked up a slight increase in stock levels.
There has been an increase in new listings that we've noted, and I also note that auction clearance rates have come off, certainly compared to this time last year. On our numbers, they're off by about 5 percentage points.
Okay, so when we get to spring and we see the seasonal surge in listings, it could be an interesting market at that point.
Oh, it will be very interesting. I mean, let's move forward to spring. We might get more of a direction from the RBA in terms of where rates are headed, if not perhaps an imminent rate cut, or if they're really concerned about inflation, we get a bad reading of inflation, maybe we've had a rate rise.
Much to come.
Much to come indeed.
Louis, great wrap today. Thanks very much for that.
Thank you, Peter.
And thank you for joining us today on Talking Property. We'll see you next time.